are in listen-only mode.
Good morning, everyone. This is Mark Raymakers here with Insurance Agency Marketing Services. I want to thank you for taking time out of your day this morning to join us for this webinar on the insurance benefit concept, infinite banking. There's a lot of different names for it. This is the second presentation here in this series. We had one here a couple weeks ago. And so for those of you that were in this one previously, you know that it is recorded. And so once this is all completed here this morning, we will email that over to you here as a YouTube link so you can view that at your leisure. The question box is open, so if you do have any questions as we go, please go ahead and type those in, and we'll go ahead and address those. Today we've got a treat here. We've got Kip Walker, who's with Mutual Trust Life, and he is going to educate us all on this particular very popular concept. And this is one thing that you'll find out as Kip will address, that they have a phenomenal product for this type of sales concept. So in the essence of time, I'm going to go ahead and I'm going to get started here. There's a couple of things. If you're just visiting us here for the first time, or maybe you've been on some of these other webinars before, we do have a couple of polls we go through. We also have some different slides that we're going to talk about, some things that we can do for you. And so first off here, we have our referred producer program. So this is kind of a neat way for you to make additional dollars by referring agents over to us. And so basically what happens is when you refer an agent over, we'll send you a check for $50 once they contract. And in addition to that, we'll also provide you 20 basis points on the business that they write. And of course, you're not in the commission business. They're not taking a commission haircut. This is basically our way of saying thank you. And just like you like referrals. You probably notice that referrals are one of your greatest sources of great clients for you. And so that's how we look at it too. They're certainly beneficial for us, and then we make it beneficial for you by referring an agent over to us. So if you have anybody that comes to mind, you can certainly give me a call at the end of the webinar. I'll give them a call, get them contracted, and start sending checks your way. I'll tell you that from experience, we have agents that are collecting over $10,000 a year. And as long as they're writing business with us, you'll continue to receive a quarterly check. You'll notice there's a market reimbursement program. I really like this. When I was an agent in the field, I wish I had something like this because I had to pay for all of my own expenses. And one thing that we do here is you write business with us, we will put money into a account for you. So let's say that you've written a couple different pieces of business here with Mutual Trust Life. We put money into the account. And then let's say you decide that you wanted to have a kind of a last minute party here before kids go back to school. You want to do a customer appreciation. Let's say you spend $1,000, you send us a receipt. We reimburse you up to 50% of the expense that you have incurred. And that can go on a constant basis. Some agents wait to the end of the year. Some agents use it every month to pay for their leads or pay for their seminars. Whatever it is that you do, you can utilize the marketing reimbursement program for that. So we do have a new producer bonus for you as well. So if you're brand new to us, you sign a contract with Mutual Trust Life, you start writing business. What we do is we have a 3-tier approach to this. So in the first tier, you can opt to take $750 cash bonus or a 2-year website that we set up for you in one business day. Now, of course, if you wanted to go ahead and get one set up without having to earn it through the new producer bonus, you can certainly do that. You can call and ask for Josh or anyone in the creative department that can get you started there, or you can get the free iPad. You might want to wait till you get to the 300,000 level, and I will tell you that these can be dollar for dollar for annuities, dollar for single premium life, or a fraction of that for target life premium. And so if you go to the second level, the 300,000 level, you can either get the Social Security program and the 3,000 piece postcard mailing, which is really a neat way to get in front of more buyers, or there's a 2,000 marketing reimbursement program, as I just mentioned for you. You're just getting a nice boost in there. So that's equivalent to $4,000 of expenses out of your pocket. Remember, we reimburse you up to 50% of that. Or you can take advantage of the $1,500 gift card. The next level, the last level, is a 500,000 level where you can get 5,000 piece mailing and seminar coaching with Matt Gill, or a 4,000 piece mailing and seminar coaching with Dave Pimper. These two gentlemen do a phenomenal job in their seminars. I've seen both of theirs and are very good at it. They qualify for all of our trips. They qualify for multiple trips actually based on that production that they generate from those. And if you wanted to, you could also buy those. So if you wanted to see how they do theirs, or you can come to one of our training academies. I'm going to have a poll on that here in just a minute. If you opt not to take advantage of either one of those two, you can get a Ritz-Carlton Travel Rewards package for yourself. Now, the back office support that we provide you, I think, is second to none. So we've got a lot of different business building tools and resources that you can take advantage of. And one of the things that Josh's team is, they can put together some great tools for marketing there. We do the back office work for you. So what happens is when you submit an application to us, you're no longer following up on that. You send it into us. We work directly with the company, and we provide you a status update. Sometimes it's going to be every few days. You'll never receive anything less than 1 week. So every week you're going to get an email, you're going to get a phone call from us, you're going to know what's available, or what's happening, I should say, on your cases. Then forms at your fingertips. Everything that you need is on the website, but one of the nice things is you can call us and say, here's what I need. We're going to get it out to you ASAP via email, fax, or overnight, however you want it mailed to you, whatever. Basically from submission to commission. So when you write a case with us, you let it go. We take it from there. We get everything done all the way up to the commission. We also provide all of your life and your annuity quotes for us. So if you need help with a case, you're not really sure which company to go with, that's where our marketing team steps in, and we do the research, we find out which carrier is going to be best, and we get those quotes over to you. The nice thing too about our group here is pretty much everybody, I would say, in fact, I think everyone has been in the field, so they understand the importance, the urgency in getting everything put together as quickly as possible for you. And not only that, but our group here, through our webinars, through direct contact on the phone, we do whatever coaching that you need to help you through the process. And paperless contracting, this is a big deal. So what I can do after the webinar here this morning is I can email you a contract, you fill that out, and anytime you want to add a new carrier, you don't have to fill out new paper. You can just give me a call, or whoever you're working with directly, they can go ahead and get you set up without filling out additional paper. So that's a real big deal. Our creative marketing department, these guys do phenomenal work. In fact, I've seen where they have taken an agent, they've branded it, they've helped them create some new marketing pieces, and that in itself really boosts their business. So we have a lot of different things that we can do for you. So there's ready-to-print customized pieces with your information on it, and we take that all the way from A to Z, whether you're just doing marketing pieces up to TV advertisements. There's also, as I mentioned, the customizable branding materials. These guys really do some nice stuff. So once you brand yourself, consumers, your clients, they get used to seeing who you are, what you are, and that can be put on everything out there. And then there's the digital solutions as well. So I've seen where they do the social media stuff. They're doing monthly or quarterly drip emails to your clients. So they can help you with all of that as well. So I'd certainly encourage you, if you're not getting that where you're at now, if you're not taking advantage of that, I would certainly encourage you to give Josh and his group a call and visit with them about what they can do for you. And then the website, if you haven't been out there, it's www.imzinc.com. Everything that you need is out there on the website. So if you are doing business early in the morning or late at night or maybe on the weekends and you're not able to get a hold of us, everything that you could possibly want is actually on the website. So I encourage you to go out there, take a look at it, and familiarize yourself with it. Of course, we're always just a phone call away whenever you need help. Something if you're looking for some help as far as doing a full, well-rounded approach to advising your clients, the Retirement Analyzer is a great program for that. And I've seen this. If you're real computer savvy, you're going to love this. If you have a hard time finding the on-off button, this is probably not going to be for you. So if you're not real computer savvy, I probably wouldn't recommend this to you. But if you really want to know, you see there's different graphs here. There's a lot of different things that's going to show your prospects and then your clients whether or not they can retire when they want to and how to reposition assets to make sure that that happens. So it's a great sales tool. I would certainly encourage you to call the annuity department, as that's really where this Retirement Analyzer is most commonly used. So call and ask for anybody there. This is something we're really excited about. The IAMS Wealth Management, we just started our own RIA, and we're able to be a one-stop shop for you. So if you're looking at managing money, I know there's a lot going on out there with the DUL right now. And so I talked with a lot of advisors. They're not really quite sure what they're going to do with their current broker-dealer. I can tell you right now that if you look at us, we have yet to find anybody who has lower fees. Our comp grid is top-notch. The nice thing is that again, you can write everything through one office, make it real simple. And if you've ever experienced our service before, you'll know that is certainly a good win-win situation for you, your clients, and of course for us, because we love the opportunity in your business. So by going out there, if you haven't taken your 65, if you're thinking about it, this is an opportunity for you to increase revenue, because your clients can come to you for pretty much everything, all the planning that you would need, anywhere from writing a term policy all the way up to putting money into a mutual fund, stock, a bond, or whatever. The more lines that you have with your clients, we talk about improved retention, the more likely you are to keep that client by offering more products to them. It really strengthens a relationship as well, because most advisors out there, when they're putting additional, when they're managing the client's money, you're dealing and you're speaking with them more, so you're more interconnected with that client. So there's so many different things: increase revenue, improve client retention, strengthen client relationships. I'm going to put a real quick poll out here, super fast. So if you are interested in maybe having someone from the IMS Wealth Management team give you a call, maybe talk to you about getting your Series 65 completed, if you just mark yes, what I'll do is I'll have one of the fine gentlemen in that division there give you a call, and they can visit with you about what we can do for you. They can talk about the fees. They can get you the commission grids. They can talk to you about everything that it is that you need to know if maybe you're considering getting your 65. And they'll explain to you too, as far as Department of Labor ruling, do you have to have a 65 license for writing qualified funds? The answer to that is yes. So if you have some of those difficult questions that you're having trouble getting answered regarding that, they can help you with that. So again, if you want them to call you, just mark yes real quick. Maybe you change your mind and you want to go ahead and call in yourself, that's fine. But just want to make sure that if you have any questions as it pertains to that, we can help you with that. Okay, looks like some of you are still waiting. I don't want to close the poll out here until I see that we've come to a screeching halt. Looks like we might be getting there. So go ahead and keep that in mind, that we can help you with that. I know that there's some advisors out there that I talk to are not real happy with maybe the service, the commissions, whatever it is that they're currently getting right now. And our gentleman over in the IMS Wealth Management can discuss that with you and see if maybe there's a better alternative out there. I think we got a great thing going on here. I'd certainly encourage you to give us a look. Okay, I'm going to go ahead and close the poll out here. We'll move on to the next point. And I know we want to hurry and get over to Kip. This is another real fast poll I'm going to put out here, and I'm going to explain this to you. Excuse me. Okay, so I mentioned to you before that we have an academy, and we have a couple of gentlemen, Matt Gill, Dave Pimper, that do their seminar presentation. So what I want you to do is, if you're interested in this at all, I just need you to mark yes. I'm going to explain how this works real quickly. We have 3 different life and annuity training academies here. We've already completed one. We have one coming up here in September. That's going to be in the first week. We fly you out on a Wednesday, and we send you back on a Friday. So what we do is we have speakers come from across the country. They talk about, this is not a product training. This is a sales concept. This is how to make you a better agent and advisor out there. This is a way to help you to grow your business. Maybe you're selling annuities right now, but you're not selling enough and you're not happy with where you're at. Or maybe you want to add something else to the portfolio. Maybe you want to start selling life insurance because you're hearing all these great things about what you're missing out on. And Kip's going to talk to you about one of these things that you're probably missing out on that we do talk about in our upcoming academy. So there's a lot of great things that we talk about. So again, here, this is how it goes. IMS will pay for your airfare, your meals, your lodging. There is no out-of-pocket expense for this training at all. So we fly you on a Wednesday evening. We do a few short presentations. We feed you on Wednesday. We get again started on Thursday morning, all-day training on Thursday. So again, we cover all your meals. We'll cover your lodging. On Friday, we get started in the morning. We're done about noon. We get you on a plane. We send you back home. So there's no out-of-pocket expense to you at all. So we have one in September coming up, and that's here in our office. We have another one that's going to be an offsite as well. That'll be in November. So if you're interested in knowing anything about this, maybe take a look at the agenda, maybe checking out the dates, mark yes. What we'll do is we're going to email you out an application. We'll email you out the agenda so you know what we're going to cover. You know what's going to happen out there. So as far as the different topics, but I would stop and ask yourself, if you're not getting any kind of free training today, you know, the advisors that I work with, they're constantly learning new things. They're putting the investment of time and energy into learning some new concepts so that they could be a better advisor for their clients. And you know what? They're making money. It's proving that their time that they've invested in this is well worth their time. Now, I know you're probably thinking, well, I can't afford to be out of the office. Well, if you haven't been up to date on what's going on, we're going to talk about things that are helping with the DOL. So anything such as simple as that, this is certainly most certainly worth your time to come out here. We've been doing these. I've been here for 8 years. We've been doing 3 or 4 of these a year, and I have never once heard an agent say this was a waste of my time. I have heard, this is a common thing I hear, is of all the different training events I've been to, this is the best one I've attended. So keep that in mind. We pay for those expenses. We got about 63% of you that have voted on this one way or another. A little surprised by that, but you know, if you change your mind and you want to know more about it, you maybe want to consider attending, all you have to do is call our number and we'll go ahead and we'll get you out an application and agenda. Okay, I've spent a lot of time on that. I'm excited about this because every time I went for any training, I had to pay for it all myself. So this is a great opportunity for you to continue to invest in what you're doing. All right, one last thing here. We've got our, we do our top producers escape every year. And it's usually an 18-month qualification. So basically how we've done this in the past is we started the qualification from July 1st all the way to the end of this year. Now with the Department of Labor ruling, we're not able to base this on production any longer. But the point is that you can still celebrate your success by writing business up until the end of this year. Generally, we do like a $2 million in point, which is all of the business that you write with us qualifies for that particular trip. And this is for agent and guest. This is going to be at the Boulders Resort and Spa, and this is going to be February 25th through the 28th in Scottsdale, Arizona. Would love to see you there. If you'd like more information as far as points, what we do there, as far as setting you up on the qualification based on different products, just give us a call here and we'll go through that with you. Okay, I'm going to go ahead and I'm going to turn this over to you, Kip. I'm assuming you have your computer up and running there.
I do, and I'm just going to get my slideshow full screen. There we go. All right. Can you see that, Mark?
Yep. Looking good.
All right. Thank you very much. Well, thank you again for having me back with IMS, and it's always great to be with you. And we've done several of these, and today we're going to learn more of the nuts and bolts of how the infinite banking concept actually works. And I'll be reminding you of, the clients we're looking at and why we're even doing this. What's the point? And with that, I'm just going to jump right into it. And if you guys have any questions as we go along, please either type them in or write them down. Happy to be interrupted with questions. That's just fine. Or we can take them at the end, however Mark wants to handle it. But we're going to go through this concept, and I'm going to show you how it works and who we're looking for. But as we go through this, I'd ask that you think of clients in your book of business, on your calendar, that you're going to be meeting with, because we're not trying to cannibalize what you've been doing to make you successful. Instead, what we're trying to do is add to your business and help you to grow your business in new areas maybe you hadn't thought about before. And this concept is also a great way to introduce whole life into your practice if you haven't used whole life before or don't really understand how it works. So as we go through this, I'm going to be going into the weeds quite a bit on some things. It's just the nature of this type of presentation. So I'll understand if there's lots of very basic questions about what's a PUA writer and things like that. So we'll be touching on all of that. And so again, we want to make this time valuable. And the only way we do that is if you actually are able to implement this into your practice. So I encourage you to write those names down and get with Mark, and we can start working on a case. That's the best way to actually learn a new concept, is to work on a case. So here's our agenda. We're going to take a look at whole life. Why does it work? We'll take a look at the structure, how the cash value accumulates under different scenarios. We'll take a look at policy loans and repayments and how this actually helps to build your wealth when it's done properly. And then finally, we'll take a look at the infinite banking concept versus a sinking fund, money used in a savings account. Okay? So our goals are to answer why whole life, how does IBC work, why IBC, why do it at all, can it be illustrated, and how do policy loans work. And just before we dive into that, again, we're looking for clients. They tend to be families. Infinite banking can be used in just about any age for many different types of clients, but typically we're looking at families 30s to 50s. Older individuals can use younger family members to be insured for them to set up their bank. So these are family members who are in decent health. We're looking for 30 to 60, 30 to 50s, and in decent health, and they love their families. And then these are the people that we're looking for. Some of the numbers we're going to take a look at during this analysis and this review are going to be pretty large numbers, but they don't have to be. The average case, I would say, in premium is about $8,000, $8,000. Street level commissions about $2,000 to $4,000. Larger when you get into business owners. They love this concept, and so don't be intimidated by the numbers. So first question, why whole life? Well, guarantees and growth continue when the cash value is accessed through policy loans. All right, so whole life is a unique product, and our product is unique among whole life products. A product that we use for the infinite banking concept is called the Horizon Value. There have been various incarnations of this product throughout our history, but they've all shared the same focus on cash value accumulation in the early years. So if you take a look at mutual trust Horizon Value versus other whole life products, you'll notice that our guarantees, almost bar none, are higher than our competitors' guaranteed cash values plus their dividends in the first 6 to 10 years. Okay, so that's our strength with that Horizon Value product. And that's important for the infinite banking concept because, as we mentioned in the first call, what we're doing is, with the infinite banking concept, we are setting up a pool of capital. That's at its heart, that's what the infinite banking concept is. It's an alternative pool of capital that has benefits that are unique to whole life. And so, sorry, my phone's ringing, apologize. So what that does is we have an alternative pool of capital that puts the client in a position of strength so that they can negotiate the best interest rates possible and put them in a position where they're actually recouping some of the wealth that they're transferring away from themselves and they don't even realize that they're doing it. And how are they transferring that wealth away? Well, they are paying taxes on their wealth as it grows. If they have this money sitting in a savings account, that's money that they need to have access to, it's traditionally going to be sitting in typically going to be sitting in a traditional financial institution like a bank. It's going to be sitting in a savings account, CD, money market. And as that pool of capital grows, they are paying taxes on the interest that they earn. All right, to get a 1099 at the end of the year, and they don't have any other benefits for it. And if they're not even doing that, then they're taking loans out based on their income. And that's not a position of strength to get the best interest rates because now you are at the mercy of the bank that will give you the loan, and then they can change the terms and they can recall the loan, and it's just not the best position to be in. So if we have a client that is building this capital up, though, they're also not in the best position, even though they're in a better position, because what they're typically doing is they're building this pool of capital up in a bank account, and then they'll take the money out, and then they'll use it for whatever they want to use it for. The money's not in the account anymore, and what that means is they're no longer earning interest on that money. So they're not just losing out on the interest that money would have earned, but the compounding of that interest on top of that. So Albert Einstein once said that compounding is the eighth wonder of the world. If that's the case, how much do you want to interrupt that compounding? Well, you don't. You want to let it keep going. And so the first lesson that we kind of learn about in infinite banking is it's better to collateralize your money than it is to withdraw it and use it and then try to catch back up to where you were. You just keep spinning your wheels. You're always just getting back to where you were before. You're not taking advantage of that compound growth. And at the same time, in the traditional bank account, taxes are eating away at the growth of your money as well. So we want to have compound growth occurring uninterrupted and in the best environment possible, meaning without having taxes draining our wealth all the time. Okay, so that's kind of the basics of what we're talking about. And it just turns out that whole life insurance provides all of those features that make up the best type of product for infinite banking. You have guaranteed access to the loans. You can collateralize that capital, guaranteed. You take out a loan against your policy, not from the cash value. That's a misconception out there. We need to make sure we have our language right. When you take a loan, it is collateralizing the cash value in your policy, and you take a loan from the life insurance company's general investment that they have, their investment assets. All right, and then they charge an interest rate. Currently, our interest rate is 5%. Okay, and the cash value in the policy is earning 4% guaranteed, and it earns a dividend at the same time. As you know, we have been through a long period of declining interest rates, historically very, very low interest rates, and now we have finally started to turn the corner and move back up. And so as this occurs, loan rates are going to be going up as well. At the same time, our investment returns are going to be going up. And as a whole life company, as a participating whole life company, we are going to share our better investment returns with our policyholders who own the company. So as interest rates go up, looking into the future, this asset becomes even more important because loan rates are going to go higher, and it's going to be even more difficult for those who are going into debt to make large purchases, whether it's a company making a purchase to expand their business, or an individual who wants to buy a new car or purchase some investment opportunity. All right, so access to capital is going to be very important, and the ability to do that guaranteed without having it show up on a credit report is also going to be, and still is, very important even now, of course, but as those interest rates rise, this is going to be even a more important asset. So whole life provides guaranteed premium, guaranteed cash value, guaranteed death benefit, and that's why it's so critical for this, so important for this concept. Our product is the best because we have the highest early guaranteed cash values, and also we let you access that money without any delay. There are many whole life carriers out there who will require a 1-year waiting period before you can start taking loans against the policy, or if you take more than one loan, they start pushing back. We've heard this time and again from other advisors who've tried to write infinite banking business with other carriers. We are designed for this business. It's about 40% of what we do. So we build our policy and our procedures around the infinite banking concept. Okay, so let's take a look. As I said, we're going to kind of get into the weeds on this. So let's take a look at one of our infinite banking policies and how it's designed. And what you'll see from this particular page is how we actually set up the policy. And you'll notice that we have an $18,000 premium. This is for a male age 45, I believe. Oops, sorry. This is a male age 45, non-tobacco, standard non-tobacco. There's no loans on this particular design. And generally what you're going to see is a 60-40 split. 60% of the premium is going to go to the paid-up additions rider. 40% is going to go to the base policy. We have a paid-up additions rider that's arguably the most flexible in the industry. And the paid-up additions rider is very important for the infinite banking concept, putting it into practice. The reason we use a paid-up additions rider is that almost all the cash value that you pay almost all the premium that you pay shows up in the cash value immediately. So it's very cash rich, and it also buys a guaranteed paid up death benefit as well. So as you can see, we have an $18,000 premium here, and we have $7,298 going into the base of the contract. That's a base contract. It's paid up at age 90. We can stop payments earlier, and there's various ways to do that. And we're not going to get into that now, but just so you know, we can design these to be paid up in as few as 2 payments if we want to, guaranteed paid up contract in 2 payments. So if you have any misconceptions about how inflexible whole life is, that should tell you that that's not the case, especially with our horizon value and the way we let you use the paid up additions and the other riders to build these cases. So if you have a client who doesn't want to get stuck into a policy so that they have to pay it for the rest of their lives, don't worry, we can take care of that. But anyway, that $7,298 buys $368,000, almost $369,000 death benefit. The other $10,702 of premium of that $18,000 is going toward paid up additions, the paid up additions rider. Okay, and most of our cases that we design are built with a paid up additions rider, just because of the nature of the infinite banking concept and the amount of business that we do there. This rider is buying $33,972 in death benefit. All right, so every year that they pay that paid up additions rider premium, it's buying additional death benefit. So it's increasing the value every time they pay. It's increasing their cash value, increasing their death benefit every time with a guaranteed death benefit. Now, this paid up additions rider, we're showing it's paid to age 75. You can actually pay it all the way up to age 90 if you want to. So, this is great for, if you go that far out and to get to the point where maybe you stop practicing the infinite banking concept, but you maybe have windfalls that you want to have some place to put this money, and you want to really pass it on and have access to it as well. You can use that paid up additions rider and just throw it in there, put it into that, and continue building that legacy and also your pool of cash. But we're showing it here at age 75. Now, the paid up additions rider can be funded all the way up to age 90, and the only requirement that you have to keep that ability open is that you have to pay $100 in premium. That's not a fee. That goes, almost all that goes to cash value and buy some death benefit. But the minimum is $100. There's a lot of carriers out there that have additional requirements that we don't have. They'll tie it to the size of the base premium, or they'll require a certain percentage of funding every 3 years, or you lose the additional funding level. Or they'll require additional underwriting after 7 years. We don't do any of that. We underwrite you one time upfront for the maximum you can get, and you just need to make sure that you pay $100 into the policy, and that keeps it active all the way up to age 90. Now, when you're thinking about, as we go along and think about this, I want you to keep in mind, I'll say pay premium and things like that. You don't think about whole life as an expense when you understand what we're doing here. We're building a pool of capital that has a rate of return, and it's safe, and it has benefits that no other product provides. It's just completely unique. So as you think about a client who might say, "Oh my gosh, this is just so expensive," it's really not. It's what we're doing is we're going to take as much money as we can find for this particular client. Looking at how they're paying for their mortgage. Maybe they're overfunding their mortgage. Is that the best way to go? I mean, you're throwing your money into a loan, and the asset that they're paying toward can go up or down in value regardless of that. Maybe we can redirect some of that money. Maybe they have really low deductibles on their insurance. Maybe we can raise the deductible, free up some money there. So there's areas we can find funds. Maybe they're contributing to a savings account, redirect that money. And we're putting it toward this asset that is unlike any other, and building up our bank. So just keep that in mind as we go along and talk about some of these premiums that we're putting in here. So that's how we're building it. The ability to fund that paid up additions rider in the degree of flexibility that we allow really provides a great deal of leeway as to how we're going to fund it. So the client, even if they can't fund the full paid up additions rider after they start their infinite banking concept, maybe they run into a situation where I can't do the full $18,000 this year. well, that's okay. As long as you fund that $7,298 plus the $100, everything stays active. If they're in a really tough spot, they may have cash values they could take a loan against to pay some of those premiums if they need to do that to keep everything active. And there's reasons that some clients may want to do that. So, again, these are large numbers. You can take much smaller numbers. I've done these with, $2,000, $1,000 premium. So, don't get hung up on the numbers. But there is a lot of variability where you can set up a client at a level that they're comfortable with and then have the paid up additions rider there to take additional money as they go along. All right. So this design right here doesn't allow for any additional money going into the paid up additions rider. Now that's important because one of the things that you do with the infinite banking concept, and one of the things we're trying to do is recoup lost interest. So as we said in the first call, you set up your bank and then you act as the honest banker. You act as the wholesaler. All right. So if you have two situations, one client who has no bank, but they haven't set up their infinite bank, and the other one who has. And let's say they want to get a small business loan. And if you look at small business loan rates, they're anywhere between 6.25% to 8%, depending on duration and amount. All right. So if you have an individual who has not set up their bank, that was their only option. Now, if they've set up their bank, we're making loans at 5%. So the individual who has set up their bank has access to money at 5% as the wholesaler. But what they're going to want to do is take the loan out at 5%, but they're going to want to pay it back at that other rate, the best alternative they would have had had they not set up their bank, which is 6.25% to 8%. They're being the honest banker. And what they're doing is they're going to pay back not at 5%, but at the 6.25% to 8%, and recoup that interest that they would have lost otherwise. They would have lost that interest, not only the interest, but the compounding on that interest. And when you think of the numbers, you're thinking, well, it's 1 percentage point, it's 1.25% to 3 percentage points. No, it's 30 to 50% of the interest that you would have paid over your lifetime every time you take a loan. And it adds up. So what you're doing is you're recouping that, you're putting it into your own bank, and it's compounding for you and growing for you to use later. And so that's one of the powerful aspects of the infinite banking concept that really puts this whole thing on steroids. So where do we put that money, that quote unquote interest, that excess interest? Well, we can't put it into the base. The base is set. It's set at $7,298. Instead, what we're doing is we are using our paid up addition as that receptacle for that additional interest. And it's going to go in, most of it will go into the cash value, as I said before, and it will, by death benefit, income tax free, guaranteed, it'll go to our heirs. Okay? So this particular design has no additional room. As you can see here, we have initial premium $10,701. Our minimum is always a $100. Our maximum is $10,701. Now, when you set up an infinite bank, this is going to be a larger number than your initial because you have to have room for the additional interest. So that's how we design it. The quote unquote additional interest goes in through the paid up additions rider. And when you take a look at the effect of the paid up additions rider on the policy, you can see the growth accelerating. So if I had shown you this policy, which is all base, this first year would be 0. Right here, this first year would be 0, because in the first year of a base policy, we have a lot of costs to recoup, commissions, and all of that, and the risk we're taking on. So in this case, we have $10,427 showing up in the cash value, and that is because of the paid up additions rider. All right, this $10,701. Okay, of that 10,400 and change is showing up in the paid up in the cash value. So that's why we use it. It shows that value very quickly, and then it starts compounding at guaranteed 4%, just like the base, and it earns non-guaranteed dividends. All right, so that's how we kind of set it up. and why whole life is so important. And those guarantees and the growth, they continue in the cash values access through those policy loans. As I discussed, what we're doing is we're collateralizing the money that's in the policy. We're not taking money from the policy. That's not what we're doing. And so that allows the policy to continue growing at its guaranteed 4% plus dividends. And how does IBC work? Well, it works through systematic loans and loan repayments from and at and to our policy using loan rates at least equal to market rates. So at least equal to market rates can be important, because what if I have access to a loan at 0%? And my best alternative is my policy's charging 5%. And I don't mind taking a loan and having it show up on the credit report. And I have, I'm not worried about, the maximum amount of credit I have available. I'm just not concerned about those other things. And I'm not concerned about making the payment on time every month, because I can get that 0%, and I'm comfortable with that. In that case, take that loan. Take the 0% loan. Take the loan from grandma that you don't have to pay back. That's not the point. The point isn't to take that loan every single time. The point is to put you in a position of strength so that you can make the best decision for you at the time. Okay? To access capital and have your wealth still grow at the optimal rate. So why IBC? Well, we're recapturing interest that would have been paid to other traditional finance companies. All right, we're redirecting it back into our own bank. In other words, into our whole life policy, and we're doing that through the paid up additions rider. Okay, can this be illustrated? Yes, it can. Let's go back and take a look at a policy. Now, we have a special illustration set up in our Illustrator. It's called the Century 2 illustration software. And we have the insurance benefit concept presentation that we can use. And we call it the insurance benefit concept because of trademark, and also because it's more appropriate and compliant with us being a life insurance carrier. So it's still IBC, but we should call it the insurance benefit concept. And it provides a description of what the infinite banking concept is right here. And it shows a graph of cash values and premiums and death benefit. And it also shows you different scenarios and breaks out in detail where the cash values are going to and coming from. And this one doesn't have a loan on it, but it would show you that as well. There's a lot of values here, a lot of different illustrations we could take a look at, and for different scenarios. I'm not going to go into too much detail on that, but just to let you know, we do have this report that can be used to present the infinite banking concept. And if you have a case, we can go into more detail on that. Many times you can use that, or you can just use the basic ledger like we've been looking at now. This is the basic NAIC ledger. But let's take a look at what a loan looks like. So here's our bank. We have it set up, and as it talks about in the infinite banking concept in Nelson Nash's book, Become Your Own Banker, you want to have some time to set up your bank. Okay, he recommends 3 to 5 years. You don't have to wait to access the capital. We will let you do it immediately, and as time goes on, the more capital you will have to access, and the more useful this will become. All right, but it can take some time for some. We can build additional capital into the PUA rider using term riders sometimes if necessary, to really juice that capital up in the early years. If they have, say, $10,000 sitting in a bank and they're like, man, this money's just sitting here, I know it's just spinning its wheels, I want to use that to help start my bank, we can do that. We can, you could have 10,000 go in plus another 2,000 each year. So there's different ways we can design these to get the capital in as quickly as possible. So in this case, we're assuming $18,000 in premium, and then the client takes their first loan in year 6, and they're just paying back. In this scenario, they're paying back at current interest rate. Okay, so 5%, they're just paying it back. Now, let's talk a little bit about direct recognition. We are a direct recognition company. That does impact the dividend. It does not impact the guaranteed growth interest rate. Our guaranteed interest rate is 4%, all right? And then the dividend adds an additional whatever it is. Right now, it's roughly about 1.5 percentage points that it adds, okay? When you take a loan, we multiply that, the outstanding loan balance by what we call a recognition factor, all right? The recognition factor is about 0.006 right now. So what we'll do is before we pay a dividend, whatever that dividend is, we're going to take a look at the average outstanding loan balance. All right, if you took out $20,000, you paid back half of it, your outstanding loan is $10,000. We're going to multiply that times 0.006. Okay, so that's going to be roughly 60 bucks. The dividend in this case, let's say before we took a loan out, you can see here the dividend would have been $6.75. We would subtract 60 bucks from that dividend. All right. So there's a lot of concern sometimes and misunderstanding about direct recognition versus non-direct. There's many other things that come into play as to how direct recognition is done, size of the loans versus the cash value, the interest rate for the loan, and whether the carrier will even let you take the degree of the volume of loans that infinite banking usually entails. That is not a huge issue, and is not for the many infinite banking concept clients or carriers, or agents that we have. It's not an issue. It's just not. That 60 bucks off of the dividend is overcome by all the other advantages that we provide and all of the other things that we let the clients do, okay? So just want to kind of address that right away. So if you do take loans repeatedly over the course of years and just pay back the interest rate that we charge, yes, it's going to end up with a lower cash value than if you had never taken a loan, just because of the direct recognition. That's typically not what we're not doing in infinite banking. What we're doing in infinite banking is we are taking loans that are being repaid at usually a higher rate of interest, because that's one of the things that helped us recoup the interest we were losing to other financial institutions. And that outstrips, and the other benefits outstrip that direct recognition factor, okay? So I'm sure we might have questions on that, but I'm going to move forward here. And so this is what it looks like when you take a loan, and we just have $30,000 being taken out. Maybe it's a business and they want to reuse it to expand their business or what have you. These are loan repayments right here. We're assuming 5%, and that comes out to $8,057 every year. This is our outstanding loan balance each year. So we're paying back the loan as we go along here and paying it back in 5 years or 4 years. 3, 4, yeah. Paying it back in 4 years, and then we have a 0 year here, no activity, and then more loans again. So that's how it works. Now, what does this all look like if we compare it to, let's say, a sinking fund? All right. What does that look like? So let's say we have, let's do this instead. Let's say we have somebody who is saving their money at a rate of 2%. Maybe they're buying a 5-year CD. All right. They have a 25% tax bracket, and they're doing this over 30 years. Okay. Now we're going to not even assume that they are getting the death benefit coverage that we're getting with the infinite banking concept. We're starting out at about $500,000 with IBC, and we're growing to over $1 million on our death benefit for our IBC policy. So we're just ignoring that value completely here. If you take a look at their value, the cash value in their account due to the erosion of taxes, and they're not taking out any loans or anything or accessing the money at all. They would just let it sit in there. And we take a look at year 30, they have $685,000 dollars in cash value. All right. And up here. because of the erosion of taxes, that's the values are not growing at their full potential. So we're going to recoup that in our infinite bank. But let's take a look at the impact of those taxes. 685,832, which is reasonable. 2% is a reasonable rate of growth in this environment. I don't know. You have to look for specials on 1-year CDs to get anything close to that at this point. But let's say we're getting 2%. And let's then take a look at where they would be otherwise when they set up their bank under different scenarios. So in this case, we have different time periods, 10, 20, and 30 years. We have standard loan, meaning no policy loans at all, just a policy put in effect, maximum accumulation, same design and everything, just no loans. And then we have one with loans at standard interest, and then we have one with the extra interest paid, and then we're assuming a 10% interest repayment in this case. All right. So the one we'll just look at the 30-year mark. You can see after 30 years, we have 814,674. The policy with loans and just paid back at standard interest is a little lower, about $6,000 lower, because again of that direct recognition. But then the one where we actually pay the extra interest back in is 824,611. So because we've recouped some of that interest that we would have lost otherwise, all right, after 30 years. So it's actually about $10,000 higher than it would have been, and that $10,000 would have been been paid away to another financial institution, and we would have had to, never had the benefit of that money again. Now, as a result of that, we get an additional almost $20,000 in income tax-free death benefit to our children as well. So it means even more to them. All right, so we can take care of the family with that. Now, if you look at the cash value at 2% on let's say the CD, so we have the 30-year mark, just cash flow, not taking the money out. It's 685,832 at 2%. So obviously, we're higher than that at 814,000, not doing anything. And some of you may look at these rates and say, well, 2%, well, rates are going to go up, right? Eventually. Well, yeah, probably. They probably are. And as they do, we're going to take advantage of those higher rates as well to invest in those and produce a higher dividend. So just keep that in mind. The numbers are just kind of for illustrative purposes, and they're going to change, but we're going to be able to take advantage of those higher rates as well. So right now, 2% is a realistic rate when you're looking at money that is set aside and needs to be safe and accessible and collateralized, or the ability to collateralize it. So we assume that the client implements their own infinite banking strategy in a savings account here. And so here they're withdrawing and paying back just the principal. So as you can see, if they just take out the principal and pay back the principal, they lose ground. All right, 685, 832 if they just left it alone, versus 678, 967 if they take out money and just put back the money. They lose out on that interest. That's a lost opportunity cost. How about if they take the money out and pay themselves back at 5%? Well, they do a little bit better there. All right, they're earning 2 in the account. They're paying back at 5. So they catch up on some of that loss, or they catch up on the loss compounding, and they get a little bit ahead. How about 10%? So they're using the savings account. They're paying themselves back 10%. Well, that gets them to 708, 835. All right. So implementing the infinite banking concept with just a regular savings account, all things being equal, they're at 708, 835 versus implementing the infinite banking concept inside our horizon value. They're at 824, 611, plus not even mentioning the fact that we have this guaranteed death benefit that's going to go to their heirs of almost $1.4 million. All right, so they have this situation where they're kind of they're not getting the best bang for their buck, first of all, but they don't have any additional benefits. So what they've had to do is they've had to buy term insurance over here, and that's cost them about $2,230 annually for a total of $666,900. Plus, at the end of 30 years, it goes away. and they have that benefit is gone. And if they want to leave a legacy, that's very important to them, because now they have to go back and see if they can get additional insurance, pay the renewable premium if it's a renewable term, which at that point is going to be astronomical and unaffordable. And if you are an individual like I am who wants to make sure that their family is well taken care of, whether I'm here or not, and I want to have them, we're in scary times right now. We have $20 trillion in debt, $200 trillion in unfunded liabilities going forward. Historically, they're talking about cutting taxes, but, we're going to have to deal with this in some point in the future. And the government seems to be unable to live within its means. That's going to create a huge burden on our children and our grandchildren. So how much is enough to have as a legacy? I would argue that that number can't be calculated. So you want to leave your kids and your grandkids in the best possible position. This is the way these clients will be thinking. And so that benefit is very, very important. And if you buy term, only about 1% of those term policies pay out. They do what they say they're going to do. And, if you have a client that has a need for a higher amount of life insurance than the infinite banking concept provides, use term to make up the difference. But in all likelihood, the asset that's going to be there for them at the end is just going to be that whole life and that death benefit that's associated with it. So we want to convert that as quickly as we can. So you can see, by implementing the infinite banking concept with whole life and with our horizon value, you are able to provide the smoother growth through not having to pay taxes. So it grows tax-free. It can be access tax-free as long as you do it properly if you need to, as a withdrawal or a loan at the end when maybe they want to start taking some income tax-free supplemental income. And it grows income tax-free. It provides additional benefits. We also have a chronic illness rider on top of this that's free. It's issued on all of our cases, table 4 or better. And if that client, God forbid, becomes ill towards the end of their working years, then they can access that money income tax-free. They can access that death benefit income tax-free up to 24% on $1 million face amount. All right. And they can do that until that face amount's depleted down, worst case scenario. So just to, add that in, that they have a lot of additional benefits that we can provide. And it really, what whole life does is it doesn't replace what a client is doing. What it does is it just makes what they are doing more efficient and lets them take advantage of it to a greater degree, because they have a legacy locked in now. They have a pool of capital, and that allows them to spend down those other assets completely if they need to. They can spend down that 401k, the IRA, the Roth IRA, sell the extra home or sell their home and downsize, or take a loan against their house or do a reverse mortgage. They can take advantage of all those assets they have now because they have their whole life policy that is in place, growing uninterrupted. It's an additional source of security for them. It's a foundation that lets them build on everything that or take those other risks because they have that legacy and that cash value foundation in place. Okay. So does the policy grow from loan activity? Well, as we saw from the illustrations, the guaranteed cash value occurs whether there is a loan or not, as I mentioned to you before. I didn't exactly point it out to you, but the guarantees grow 4% uninterrupted whether there's a loan or not. There's just that impact on the dividend, which is pretty small, and that's only on the dividend, not on the guaranteed portion. Loan repayments based on a rate in excess of MTL's policy loan rate will add additional growth to the policy. So it doesn't grow from just taking loans and repaying them back at our interest rate. It grows when you take a loan and, acting as the honest banker, pay back at the higher interest rate you would have had to have paid if you didn't have your bank set up in the first place. All right. And that is the basics of the infinite banking concept and the kind of the nuts and bolts too of how it works. I know we got into the weeds on a lot of things. I understand that there's a lot of questions and I may have bewildered some people, so apologize for that. But happy to talk to you more about this on an individual basis. If you want to get with Mark, and we can talk about a case if you have a client in mind. I would just like to mention that as Mark was talking about, that IMES has its trip that you can qualify for, where you can actually double dip if you do business with IMES, with us through IMES. We also have a fantastic conference we call the Vanguard Conference, and in 2018 we're going to Australia. If you sign up with us in the first 4 months, we double your credit towards attaining that, or towards that trip, that Vanguard trip. And they're very, very reasonable goal requirements for qualifying. It's $30,000 of NBC, and NBC can be calculated as 52.5% times base premium. So when it's all said and done, if you did the required business in the first 4 months, you could get to Australia on as little as $30,000 in base premium. It's a significant amount of business, but it can be done. And if you contract with us after August, you can apply that credit towards either the Vanguard conference or toward next year's conference, whatever that may be. And we'll let you apply those double credits towards whatever conference you want to apply for, which that's a great great incentive to do as much business as quickly as you can, to then have the option to qualify for either conference. We also have business education reimbursement. I know Mark mentioned that IMES has a similar program. You can earn up to $1,500 in education or business expense reimbursement with Mutual Trust, and again, that's based on production. So with that, Mark, I really appreciate the time, and I'm happy to take any questions.
Okay, so what I want to do real quick here is I want to put out a fast poll, basically just determine if you're interested in getting contract with Mutual Trust. Just mark yes real quick here, and then I'll email the contract over, and it's just simple as filling that out, emailing or faxing it back to me. And then what I'll do is I'll go ahead and I'll get the poll open here for you. Just a question, because I think this pretty much covers your screen. I don't know if you can type questions in when this is up, so I'll just leave this up real quick. If you want to go ahead and mark yes or no if you want to do that. And then I'll go ahead and I'll drop that down here. I'm going to let this go for another 30 seconds, and then we'll go ahead and let you dive into the questions. And of course, if you have any questions for me as well about IMES, insurance agency marketing, you certainly type those in the question box as well. But I think right now, if we can take advantage of Kip's time and the infinite banking, this is kind of a neat deal. While I'm letting this poll set up here for another 20 seconds, we've had agents that, once they understand this concept, they've been to our training academy I talked about before, and working in conjunction with Kip on this, we've had agents qualify for the last trip just within a few months. They're generally a larger premium. So I would encourage you to get involved in this. This is a really neat concept. We have one agent that this is all that he does, and he qualifies for our trips based on that type of production, or that type of concept. Okay, so question box is open. If you want to go ahead and type something in there, we'll go ahead and take advantage of Kip's time and knowledge while we've got him here this morning. It's looking pretty empty, Kip.
I either bored them to death or I answered all their questions, one or the other.
I like to think you answer all the questions. One thing about this too is it's obviously something you just don't pick up overnight and run with it. Those agents and advisors that have been successful in this have spent some time studying it, learning it. Nelson Nash, if you go out there, he's got some great books out there on this concept if you want to purchase that. I know there's been quite a few. Once we've done these, agents have gone off and they've purchased that book online so that they can become more familiar with this concept. So certainly encourage you to do that. Okay, we do have one question's come in. Yeah, Greg, what this will do is we'll email out the recording for you. So you'll get that probably later on this afternoon as far as the recording is concerned. So yeah, I'll get that over to you shortly. And generally what we do is we put these out on our website as well. So if you go to www.imesinc.com, you'll see that we have at the bottom of that first page, you'll see that we have webinars. There's recorded webinars and then a webinar schedule. So if you just go to webinar, recorded webinars, you'll see that that is in there for you to review. Okay, well, Kip, looks like the question box is empty. If you do have any questions, you can certainly call our office here, 800-255-5055. You can ask for Mark or anyone in life marketing. We can help you with this. And certainly don't ever hesitate to call about anything we can help you out with, whether it's life-related, annuity-related, or even the IMS Wealth Management we talked about here earlier. So thanks again, Kip, for your time here this morning. I know you're very busy.
Thank you.
Yeah, and thank you all as well for taking time here to learn about this new concept. We certainly like an opportunity to help you out with a case here in the very near future. You can expect a call back from me here too within the next day or two to discuss how we can help you out with this. So again, thank you. Keep your eyes on your emails. Check your spam folder if you don't see this here by the close of day. And again, have yourself a great week and appreciate your time. Thank you.
Thanks, everybody.